Good afternoon, everybody. It feels a little bit too late to say Happy New Year, but welcome to our first monthly webinar of 2025. For our regular webinar watchers, you will probably remember that back at the end of November or beginning of December, we did a kind of year ahead special from the strategy team. So I ran through our key views for 2025 that we thought would be driving markets and specifically FX. So we're going to change things up a little bit this time around, and we're going to start with Piers, who's going to give us his sort of technical outlook for 2025. And then he's promised me some time at the end because, like I say, there's still plenty to talk about from a kind of strategy and economics perspective. But without further ado, Piers, over to you.
Thank you very much, Imogen. Right, I was just going to give my view on the technicals for the year. So what we're trying to do is working out where a market is going. Now, a lot of people are under the misconception, I feel, that markets and events are random, driven solely by fundamental laws and news, meaning that market turns and stalls can't be timed or predicted. Now, from my 35 years of studying the markets, I believe charts tell us otherwise. Charts were around before modern day economics. They're just not as widely publicized. I feel that markets are driven by mathematical order and history, as usually it's the same sort of patterns, retracements and cycles that happen time after time. Hopefully this presentation will help you see that. So today's the year ahead. We're going to look big picture. For the shorter term levels, you've got my daily and weekly charts where we'll look at it, and we've got the monthly webinars where I'll look more like at each month as they go along. So we're in the year of the snake. Now, we've only just entered that, and while a lot of people here in the West, like my friend Del, think, oh, snake, I don't like them, and we tend to think of each year just as, what animal is it? They are more important in China and parts of the East than we realise, and they take it seriously. And with much more money and influence being traded from that part of the world nowadays, I like to understand what they feel each year symbolises, and the main point that it sort of signifies. Now, on the year of the snake, I've read the snake is a double-edged creature. It's embodying both wisdom and danger. While it offers opportunities for growth and insight, it will require careful navigation to avoid its hidden perils, because snakes are strategic and be tempted by big opportunities, potentially with overconfidence in high-reward investments, so potentially high volatility and hidden risks, sharp losses. Now, I think that's very interesting because we've already seen the year of the snake kick off with high volatility. So immediately it's there. Now we need to keep a close watch what happens with equity markets this year, as they'll have strong impacts on the dollar. And that could be in both directions. There's a lot of people calling a top and saying, oh, this is the big top in the equity markets. But that sort of puts me off just slightly, because usually when everyone says there's going to be a market crash, they don't crash. It's when you're not expecting it. Like if you're driving in your car, it says icy road, you're more careful. If it doesn't say icy road, you tend to skid off. Also, usually there's a big pickup in two-way volatility as the sellers battle the trend followers. Now, we might be starting to see that in the equity markets, but it's important we keep you informed, and we will on these monthly webinars as the year goes on, what the immediate shorter-term risks are. And we'll update you on the monthly webinars, as I say. But if we go to the next slide, this is the dollar index. This dominates FX markets. So what we really need to try and do is work out what's happening to this. So if we go to the next slide, what could impact the dollar's value? Now, these are things you hear about all the time. Geopolitical tensions, inflation, interest rates, equity markets overstretched. Are they going to fall? But I'd say wait and watch for a sign of exhaustion, because any trend is intact until it's given a clear signal that it has turned. And years ending with 5, on average, are positive for equity markets. But I do feel, this is a personal view, I feel that personally might be nearer a bigger top than a bottom over the next few years, but we'll come on to that later. So if we go to the next slide, I'm going to look at equity markets, and we're going to sort of think one thing. And actually, I just suddenly realized there was just one thing I wanted to say. If we go back a slide, sorry, this is going too fast here. But all those factors that you hear and talk about equity markets, geopolitical tensions, inflation, interest rates. Everyone's talking about them. What I think is going to hit us or hit the markets is something not on people's radars, such as cyber threats or something we're not even aware of. Because the greatest risk we don't normally know at the start of the year. If you think back just since 2020, we had COVID. No one was talking about that a few months before at the start of the year. The Ukraine war, no one was talking about that a few months before. The energy crisis, Liz Truss, they're all things that have happened in the last few years that people weren't talking about at the start of the year, but soon dominated the year. So be prepared, if necessary, to move quickly in the double-edged year of the snake. We know what it looks like today, but where are the targets and where do things change? That's the important thing. Don't get too wed to a view. I'm going to give you my views here, but I'm going to give you where does it change? This is my view, but where does it change? It's important to know where do things change, because timing is important, and we will continue to try and help you with those issues. One thing, and I really want to go back to the slide to say this, remember markets are not rational. They are dynamic. They change as they're driven by greed, hope, fear, and panic. They're not door numbers. They don't stay static. They jump all over the place. And this year, I think you could see a lot of greed, hope, fear, and panic. Right, so this chart we're looking at now is the S&P 500. So is it going to be FOMO or FOLO? That's what people are trying to work out on equity markets. Is fear of missing out in case it goes higher, fear of losing out in case it goes lower. Now, this is quite nice because it's a very mathematical, all markets are mathematical. I hope to show you that today. But here we are, the S&P, since the financial crisis collapsed, and I can't believe last year I met someone, I was talking to them, they didn't know what the financial crisis was, made me feel very old because they were working in the city and I thought, you don't know what the financial crisis was. But from 2008 to 2020, and then the COVID sort of pullback, I've got the move, you take the move back, then you put on the extensions. If we go to the next slide, you'll see the extensions a bit clearer. The market needs targets. Any market needs targets. So as it goes up, it's like you're on a road trip. Or, I know this is a good example to use, a pub crawl. You're going to go to different pubs, you've got them in your mind. You need to get there. Then you stop. Then you pause and you think, where do we go from here? Now, look at the black circles. It's just done the extensions perfectly. But the S&P stopped at the 61.8%. So for the last 2 quarters, it hasn't managed to break through that 61.8%. Now, if it's going to carry on higher and the bulls are in control, because at the moment, they're green quarters as we go up, so the bulls are still in control, the sellers haven't taken over. If they get a close above 60.60, you're probably going to see a move up towards that 76.4. And why is that important? Normally when markets are calmer and they're going up like that, the dollar loses a bit of strength. But as I said, we need to know where's the other side of this. What happens if it doesn't, if it can't break that 60.60 and starts to come back down? Well, I would say we probably look then for the 5,500 area, the 50%. Now, if price starts to get below there on a quarterly close, that would be a signal to me that actually maybe the equity markets are starting to do a big pullback. It's not decided at the moment. Look, you're midway between the high and the low this quarter so far. So this year, price is in the middle of its range. But if it gets down below that 5,500, then I'll start to think this market might be turning. And that would mean dollar strength. But as I say, we need to keep going with it as we go along. So 2 nice simple areas to watch. 5,500, then let's say 61 for the top. In between that, it's just a sideways range. And it's outside those, the dollar will start to, well, the equity markets will start to change and that could impact the dollar. But let's go to the next slide, because this is the NASDAQ, the new kid on the block, basically. Always in the past, it was the Dow Jones and the S&P people looked at, but nowadays, everyone wants NASDAQ stuff. eBay, Apple, Amazon, Tesla, now it's NVIDIA and Palantir, and that's what's shooting up and taking a lot of the other markets with it. So again, let's check what this is doing. So on this slide, we have that 2008, 2022 is after COVID when it started to come down as people weren't using the growth wasn't so huge in things like Amazon. So we take that pull back and then we look at the extension. So we go to the next slide. I've zoomed in so we can see it more clearly. If we look at that extension rally out, you can see that, again, it's wanted targets. People want a target. Where do I go to? I'll take some profit. If it moves back, I'll buy it there. Rule of polarity, support and resistance switch. So that's all we've had all the way up. So where's it stopped? It broke the 61.8% and it stopped last quarter at 76.4%, exactly on the dot, you know? So what have we got since then? It's a bit like the S&P. Price is middle. If you look at the last little bit of candle on there, price is mid, the high and the low. The market's indecision. It's not sure. But where will the market be sure? If you start to get above 22,500, 600, people are into the NASDAQ again. And people want to buy the NASDAQ shares. And that will be going higher, maybe up to the 2,400, 2,600. If you get down to, say, 61.8, it's about 20,000. So let's say 19,000, give it a bit of leeway, because if it's going down, you want to check. So let's say 18,000, 20,000 on the NASDAQ. That should be support. If it breaks below there, then something starts to change on the NASDAQ. And that might be that, people are getting into the dollars. They want to be out the equities they normally go into the dollar. So these are the sort of things we need to watch. It's not just a straight case of just looking at FX. You need to know what's going to move FX potentially. And there's always, as I said, that event we're not ready for, that could move it. So let's go to the next slide. So this is the dollar index yearly chart. Now, this is the key. We've said that for a long time. And look at it. It's a beautiful chart, as Donald Trump would say. It's nearly as beautiful as the word tariff. But look, the move down from the high to the low and then the rally back up. Since 2008, the dollar has simply been in a long-term bullish upward channel. That's those two pink lines going up. It goes to the top of the pink line. That's the top of the channel. Comes to the bottom pink line. That's the base of the channel. Then it goes back to the top of the channel. I'm at the top of the channel. What should I do? It's the top. People sell. It goes to the bottom. What do people do at the base channel? They buy it. So it goes back up. Where did it go? It went to the top of the channel a couple of years ago. Then it's come back down towards the base. But it didn't quite get to the base, but rallied back up. That's because it's in an uptrend. So all it's done is steamroller. Anyone who's been a dollar bear in the last 2 decades nearly has just got run over by this uptrend. But there's another thing we can look at that. So we know it's an uptrend channel. We can look at the retracements. So those retracements, I put one line in green, which we've looked at many times on this webinar. It's the 38.2 retracement line at 106.60 area. Now, for the last 2 years, that has capped the dollar gains and it's stalled there. But last year, the dollar managed to close above that for the first time. So the first time, it's got above the 38.2%. So that's a positive thing, which is why the dollar kicked off strong start of the year. But it needs to carry on. It needs to get to the top of that channel. So I sort of see resistance probably at the 113 area, because that's the top of the channel. And let's just see how we get on when it gets to the 113 area. The base of that channel is round about 100. So if we get below 100, then I'd start to worry. Oh, look, something's changing. The dollar's lost its bullish feel, and we might be going into a dollar bearish time. But now we'll go to the next slide. And this is slightly different retracements. But again, this is a smaller one. This is just from 2000, the last run down, and then the moves back up. But again, I put the circles on. It's so mathematical. It just goes from one to the next to the next. But what's it done? It's stalled at the moment at the 110 area, which is the 76.4%. It hasn't stalled round slightly above or slightly below. It's stalled on the dot this year, which tells me it's not just me looking at it. It tells me a lot of people must be looking at that line to sell it there. So that, coupled with the 113, I think this is the resistance area for the dollar index. So as the dollar index gets into the 110, 113 area, that's where it's really got to break through to see another leg higher. At the moment, that's just capping it. So we know where the resistance is. Now, the 61.8% on this chart is at 103. And that's where previously, if you look back left, that's what capped the market for many years. So that should be, through the rule of polarity, support if it comes down. Because it's being mathematical all the way up, why would it not be mathematical coming down? So we go to the next slide. Let's try and work out where the downside could be. Because we've looked at the upside and we sort of know this 110, 113 is a sort of key area of resistance. But on the downside, what are we going to look for? Well, if we take the move that we've had up from last year, the rally from mid last year up to the high, so that's from 100 to 110, the 38.2% of that move is 106. Now that ties in with the 106 from the other area, from the last chart. So 106 to me is going to be a key area. If you start to see the dollar index below 106, it's losing some of that sort of macho status it has at the moment. And you'll probably see a bit of dollar weakness come down. But then where's the 61.8 and 76.4? Well, they come in 102, 103 area. Well, 102.5, 103. So that's going to be a real crux. If it comes back down there, it needs to find, the dollar needs to find some buying interest there, because that'd be a retest of the old downtrend, the 61.8 and 76.4%. So on support, if you want to stay and you hope the dollar's going to go stronger, or you're thinking the dollar goes stronger, you need to see the 106 area hold. If it starts below the 106 area, you have to start thinking about that and saying, right, we now need to see the 102, 103 area hold. Because if that starts to go, then something's changed on the dollar. Where are all the buyers? Where's all this impetus gone? So that will probably affect it to the downside if it gets through 102.5, 103. So I'd watch 106, 110 as a starting gauge and go from there. But at the moment, you can see the spike is coming, its price is coming off the spike, so the market's just consolidating. And we now know where we change our view, and that's always important. We knew it from the other chart, 100, the base of that channel. Below 100, that means you've taken out that 61.8, 76.4, and you've broken the channel. That's where I think the dollar's really had its day. Right then, the next chart is sterling index. Now, I call this Goodnight Sterling Index chart with a question mark. It's given splendid signals over the last couple of decades. And it only went positive post-Brexit in 2023, when price had broken and held above the 38.2%. And I found it very useful because before, the 38.2% had capped it. All those black arrows going along the top post-Brexit, it saved me from getting caught up in those sort of fictitious stories in the press beforehand when, let's say, Boris Johnson got in, oh, sterling's going to rally, this is the time to buy sterling. No, it wasn't. You hadn't got the signal. It fell off after Boris Johnson got elected. It went down. It only gave the signal in 2023, and then it went up. Where did it go to the 61.8%? But the sad thing is Bloomberg have finished this chart. They don't publish it anymore. But we can't do the sterling index anymore. But I thought I'd just explain why. Let's go to the next slide. Sterling dollar, yearly candle. So this time of year, as I said at the beginning, we look at the yearly charts. So what have we got here? This is a yearly chart. Each candle represents 1 year. And I like this one because it's just very basic. And I look at this from time to time and just think, what's happening big picture? So the definition, the basic definition of the downtrend, or if you're going to dictionaries and things like that, is always a downtrend is formed by a market having lower highs and lower lows. And that's all you've had since 2008. So you haven't had a higher high or a high low. So just stick with the downtrend. I mean, it's worked well since 2008. It also helps when you get things like, we had the 8-year cycle last year, which would be a negative year. And it was a negative year. It closed lower than it opened. So it helps when you're sort of thinking that at the beginning of the year. Yeah, you know, what could be happening? So what do we need to see to change our view that sterling dollar is in a downtrend? You just need to see a higher high or a higher low. Well, you really need to see both, a higher high and a higher low, and that will signal it. You also have this fantastic thing on the yearly chart. It's from the Bollinger Bands. It's 20-period moving average. It's the pink line going along the middle. Now, if you look at that, I put two sort of like Batman zap things on it. One says 5 years, one says 6 years. So that's 11 years where that line capped sterling dollar. So if sterling dollar had rallied those years and you thought, right, when it gets to that line, I'll just buy my dollars, by the end of the year and into next year, you'd have been very happy. So where's that line? It's always worth knowing where that line is. So that's 146. So you need higher highs and higher lows, and you need to break that 146 moving average, because until that breaks, there's a risk that as you hit that, price falls back off. But that's big picture, very basics. Now look a bit more in depth with technical analysis. So on the next slide, this is since 1970. It's the longest one I could get. So it's got all the moves down from 1970, where it's up sort of the 264 area, and then from the sort of 245 area where it fell off in the 1980s. And they're two good retracements, but they come in quite close. So 137, 142 is the first retracement, the 23.6. But what's important about that, you might say, why is he talking about this? Because if you trade sterling dollar longer term, and you do it every year in and out, you should know that area, because from 1985, every dip was held by it. So it got down to that 23.6 and was just bull. And the price rallied and it went down, it rallied, went down, it rallied. So it got very lazy trading, as they say, because if you're a fund manager, you could just shut your eyes, buy cable, and next few years it rallied. But that changed in 2016. Price broke below it. And this is where it's important now for people, because when you get this chart and you zoom in and you look, you'll see that that same orange line and blue line, that area, 137, 142, has held every rally since Brexit. That just spikes into it. It gets into that area because rule of polarities come in. So now people just sell it. So it gets in there, it sells off. So if you want sterling dollar higher, make sure you're above 137, 142 on a yearly chart before you get too sucked into this is going to the moon. Gets above there, good. But I still think any first attempt into there should find some selling. So I'd just like to know big areas where things could change. The next slide, this is the yearly chart putting the extensions down. And you can see there's a great trend line going across. That trend line's had 5, maybe 6 if you count this year, because it went down near it and rallied. So that trend line for 6 times, there's been 6 years when it's got down to it and it's rallied off it. How useful is that? How mathematical? So then if we zoom into the chart by going to the next slide, this is just the extensions bit that we're going down. If we look back at that move since the 2008 collapse, you can see a green line going across, which is the 38.2%. Well, since Brexit, that shows that it's touched that 2 line, 142.67. It comes in with the other one, the 142. So it shows you there's a lot of resistance there. A lot of people are going to sell. And what's it done? It touched it and it fell straight off. Now, where did it go? It went down into the 61.8, 76.4 area, which is sort of the 119, 124 and a half area. And that's got the trend line coming in it. So that's going to be a big area for sterling dollar. There's a lot of reason why people are going to buy it longer term in that area. So it's good to know. Now, this chart is important because I put out a call to 130 when cable was 160 back in sort of 2014. A lot of people thought I was just a bit mad. But it came from this chart because the 50% extension, the previous low was that 133.64. And it went to 130. And now that's resistance. Look how that line has capped it. 133.64. You haven't had a yearly close above it. And in fact, last year, you went up to that 33.64 area. And what happened? It fell off and people were all shocked. Why did it fall off? It's mathematical. Long-term people were like, this is the time to sell. If we go to the next slide, this is my weekly chart from the 23rd of September. And the only reason I put this in, this is why it's important to keep up to date with the stuff we send out on the weekly and the daily charts. I put there about the importance of the 134 area. And I put it in an orange line. saying risk reward will change here. But I think a lot of people were very caught up that it was going to go to the moon. And so I don't think many people took much notice of that, but it did. It had a really strong fall off that. So keep looking at the weekly and daily charts. So we go to the next chart. And this is the monthly chart. This is just a bit shorter term in case people want to come out and have something to look. So we've got the 120.90 area on there, weekly support. Now, if you've been getting my weekly charts, I've been talking about this 120.90. And what's nice is you've got a lovely bounce off it this time. Now, I always say, look left, I put on these slides. Look back where it stopped. So every time it's fallen to 129, it's bounced. So people know it's the lazy trade. We'll just buy it here or rally. But it's also the 38.2% is just below that at 119.45. So there's a lot of places to watch. And at this stage, I'd watch 118 because I have a monthly line on another chart, but I've stuck it onto here as well. 118, 120.90. So that's my support zone. 118, 121, that 3 cents. If we start to get below there, then I think everything's in trouble. Well, sterling dollar's in trouble. But at the moment, on the shorter term charts, the daily charts I've been sending out in January have had a risk reward change at 121. And that's worked quite well. And now we're looking at a potential flag in sterling dollar on the daily charts. So keep watching that. Is that still playing out? So we need to sort of also think on the bottom level here. The bottom level here is 0.9534. That's the 100% extension down. And why is that important? Because we had 0.95 actually on another chart earlier on, but I didn't really highlight it there. But it's the sort of stretch target I've had for some time, 0.95. Over a decade ago, I said we could get to 0.95. We got very close with the Liz Truss stuff. We got down to 103. And really, until we sort of get some change, that target stays there. And this is Gann lines. So Gann lines are automatically drawn. I haven't drawn them. The computer luckily draws them automatically. But look how each line, it's a yearly chart, the lines start as support. And when they break, the line that's broken becomes resistance. The next line becomes support. And it works all the way down. It goes back up to test it, goes down to the next one. So 129 is the Gann line. And it broke the other year. It broke 3 years ago, and it hasn't managed to get and hold back above that 129.83. So if you get a yearly close above 130, this starts to lose its force. But it's just interesting to me, the next one down is at 0.79, but with time going down, probably 0.77, which is why I talk about 0.77, 0.79. This is the chart that's talking to you about it. So if we go to the next slide. So instead of like praying to the gods like some people do, or they shuffle the decks, why don't we try and figure the odds by using a quarterly rolling check on sterling dollar? Instead of trying to say, look, we'll put all our cards out now and go big on one rate, I think it's much more sensible to say, right, where's the support, where's the resistance? Well, on this quarterly chart, I sort of see the 122.56 is 38.2 and 121 sort of below there I like from that other chart. So I'll say, that's your support, 121, 122.56. While you're above that, you could see a test back up towards, you have the moving average at about just below 128 and then 130. So 128, 130 should be a resistance. But where does it change? Where does it change from negative to positive? Above 133. I've written it on that chart. If you get a quarterly close above 133, people aren't worried about whatever they were worried about when they sold sterling dollar off that high last year. Right. So that's sterling dollar. We'll look at that chart every quarter on the webinar as we go along. So this is the FTSE. Again, very mathematical. These are the extensions going up, the 100% extension, and we've got a line above there at 90.10. Price has just stalled around that 100% extension, and it's starting to come off. But if you start to get above 9,178, then I'd look for a move up to the 123, 138 in the 10,000s. But at the moment, I've just watched that because that should be resistance on a first touch, which is clearer on the last and final slide. So here we go. You can see that much clearer how it is. Now, what about if it falls back off? What happens if so at the moment, I'm seeing 8660 on this chart and just below 9, 9,000 as a sort of resistance zone, moves back down. If they're going to be moves back down for a rally back higher, they need to hold that sort of 7645 area, the 61.8. Because if you look at those two green circles, that's what's capped it in the past. So rule of polarity, that should be support going down. Risk, I just have a big risk, sort of from 26 to 30 is a big risk time, I think, for the FTSE and maybe equity markets, mainly because it'd be 100 years for the since the 1929 collapse. But look, I'm going to give some time to Imogen. It's been too long. It's a lot to cover. Imogen, over to you.
Thank you, Piers. Just quickly, I guess, the last few minutes on the strategy side. I mean, it's difficult to believe, I think, that we're only 4, 5, 6 weeks into this year, and I feel like we're already on a 4th or 5th crisis of the year. You know, it feels like a distant memory that we were also concerned about UK fiscal risks, and then also concerned about, you know, the equity market crashing and the future of AI, and even partially a bit of a distant memory about tariffs, of course, over the weekends. But I think there are some things that we have learned from the way that the market has responded and what we've heard, particularly on the tariff front and from politicians in the US, that are worth reflecting on. And I'll start with the US because I think that's clearly sort of front of mind for all of us at the moment. Whilst there's an inevitable unpredictability about the current sort of foreign and tariff policy at the moment, I think there are some conclusions that we can draw from what has happened over the last couple of weeks. The first, to me, is that it's not necessarily obvious at this point to what end these current tariff announcements in terms of Canada and Mexico are being used. And by that, I mean, it's not obvious what President Trump will be looking for by the 1st of March to ensure that these, you know, there's either further delays to implementation or they're taken off the table altogether, or even what he might be responding to, you know, in future months that might be a removal or a scaling back in those tariffs. The second point is that what we're seeing clearly, obviously, in the market already is some of this tariff risk premium being priced out, and rightly so, but it, of course, won't disappear immediately. You know, the threat of tariffs on other countries hasn't gone away. The euro area seems clearly in the firing line, but there will be others. I'm not sure many of us necessarily had Colombia, for example, on our bingo card as being one of the first targeted countries. But also we're starting to see retaliation. You know, the tariffs were put in place against China. And so whilst there is some sort of diminishing tariff premium, it won't be fully priced out of the markets. I think if we've learned anything over the last couple of weeks, it's very clear that tariffs are Trump's sort of go-to negotiating tool. They are his go-to power play, if you like. And he's very happy, it seems, to use tariffs at the expense potentially of other strategic objectives. So it's immediately clear to me that tariff risk will disappear very quickly altogether. But I think the good news, and certainly from kind of sitting on the side of a sort of market participant, the good news is that the market will increasingly become desensitized to these tariff announcements. You know, it appears currently that Trump's bark is a little bit worse than his bite when it comes to tariff policy. You know, we've seen lots of threats. We're up to 3 countries now where imminent threats have been made, and ultimately those implementation dates at least have been pushed back, if not softened. And so I think we will start to see a market that becomes much less volatile around, you know, tariff headlines and the potential implications, which is a good thing. I think it's a good thing for risk markets. Ultimately, probably a negative for the dollar, and that goes back to the point that I'm making, that, you know, I think the perception of his tariff policy is definitely that the bark is worse than his bite. And so some of these kind of dollar tailwinds, if you like, when it came to Trump's tariff policy, particularly with regard to the inflation outlook and what that might mean for the Federal Reserve's reaction function, have just lost a little bit of their punch. Of course, when we think about the dollar, it goes beyond just tariff policy. We have to think about the near-term policy response from the Fed. I think they've made it quite clear at the recent meetings that they are still on hold. We expect them to remain on hold until June, and perhaps only cut twice more this year, so a quarter-point cut in June and a quarter-point cut in September. That is a relatively hawkish monetary policy stance, and I think you would argue, given the strength that we've seen in the data of late, coupled with tariff risks, the risks to that view are that those cuts either materialize later or in fact they don't materialize at all, and the Federal Reserve kind of settles at a higher terminal rate than we've been expecting. That's a positive for the dollar from a sort of relative rates perspective, if you like. That would imply that the US is settling at a much higher terminal rate than we're seeing in the euro area, potentially higher than we're seeing in the UK as well, which I will come on to. And there's a sort of growth exceptionalism story here in the US as well that I think we have to account for. Trump has a lot of policies when it comes to fiscal, when it comes to tax, when it comes to deregulation, that are all likely to drive a relatively bullish outlook for growth for the year ahead, or years ahead, I should say, and probably offset some of that negative growth impact that is perceived from tariffs. But I would argue that these kind of ongoing tailwinds, so the relative rate and the sort of relative growth exceptionalism story for the dollar, are we're quite well priced now, and we're probably getting to a point in terms of dollar positioning that is looking a little bit stretched, and those valuations are starting to look a little bit stretched as well in some cases. And so we think that the dollar is still quite vulnerable to a sort of underlying change in the outlook. And whilst there is this ongoing bullishness at the moment about the US economy, and we are still expecting a downshift, particularly later in the year. And we think that leaves risks to the dollar as to the downside, coupled with the fact that this kind of tariff tailwind for now appears to be abating a little bit. Very quickly, just in the last minute on sterling, because I think the Bank of England is obviously in focus this week. The bigger question mark, I think, for the Bank of England and for markets as a whole is how their reaction function is likely to shift over the next couple of months. The Bank of England has this major question mark when it comes to its outlook over the impact of the national insurance contribution hike and how that is going to play out in terms of the macroeconomic challenges that the UK market is already facing. And by that, I mean there's a sort of inflationary impact if firms look to protect their margins and cover these input cost increases with price increases. They look to pass those on to the consumer. But there's also potentially a much bigger growth impact and ultimately disinflationary impact if we start to see wage cuts, job cuts, fear of job cuts, and a bigger kind of labour market shakeout than the Bank of England currently has in its projections. We think the inflationary impact will dominate in the near term, and the disinflationary, the sort of bigger labour market shakeout, might happen, but it's unlikely to happen before the end of 2025 or perhaps even 2026, we think. So there's still a kind of relative rate story at play in the UK as well, particularly when we compare that to the euro area, where inflation is much better behaved. We think the ECB is on course to continue to cut at every meeting until June to take that terminal rate back to 2%. And of course, the growth outlook is relatively weak in the euro area as well. The BOE is grappling with a similarly weak growth outlook, I would say, but I think in the near term, they are much more concerned about the inflationary outlook. The UK has the sort of double-edged sword, if you like, of having an inflationary problem that's similar to the US and a growth problem that's similar to the euro area. But I think it's the inflation side of that coin that dominates in the near term. So we're still only expecting 2 more rate cuts from the Bank of England to take that terminal rate to 4%. And again, we think that relative rate support, which is influenced by the fiscal as well, can be some support to sterling over the next couple of months. I will stop there because I appreciate we've already gone over time, and that was a really kind of whistle-stop tour of our latest thoughts. But if you did have any questions, either for Piers or for me, then like I say, please reach out to your sales contact or your relationship manager at NatWest, and we will do our best. Thanks. See you next month.